We're going to have a great panel discussion here. We've got the three leaders of three consumer lending marketplaces here to tell us about customer acquisition strategy, following off from the last panel. Before we do that, though, let's start with a brief introduction, because not all marketplace lenders are created equal, and you each have a very interesting story. So give us a brief insight into your business, and perhaps just comment on the funding side, because we're not going to be exploring that so much as the consumer side. Starting with you, Ben Taylor from Harmoney.
Thanks, Kieren. Harmoney is a consumer P2P lender, marketplace lender. We're headquartered in New Zealand. We've been operating there for roughly 2 years, but been lending for nearly 18 months. In the first 12 months, we wrote or matched $100 million in volume, and we've just clocked over $200 million in volume about 2 weeks ago. I've spent the last year setting up Harmoney Australia. We've got our licenses, we've got our funding, we've got our IT systems up and running, and we're now in private beta in Australia. So we're looking forward to a full launch in a couple of months in Australia. From a funding perspective, from a New Zealand perspective, where we're well entrenched over there, we have a range of institutional funders and retail funders or investors, mum and dad investors. Mum and dad investors can invest from as little as $500 through to $10,000 or thereabouts. They invest in notes, in loans, fractions of $25 of each loan, and they're very active in the marketplace each and every day. I think we have something like 2,000 to 3,000 mum and dad investors on the marketplace every day buying loans, which is fantastic. And we have half a dozen large institutional funders that back us as well and provide liquidity in the marketplace, and funding lines of around $500 million.
Great. Thanks, Ben. Stephen Porges, welcome. You want to tell us a little bit about DirectMoney?
Yeah, thank you. And firstly, I just apologise if I disappeared a little bit, and having just flown in sort of about 3 hours ago. DirectMoney is, the first listed business down here. We're a consumer unsecured loan business founded by David Doust, our founder, just over there in about 2008. But it was sort of when the GFC hit, David was sensible enough just to sort of put it in mothballs for a while, and then we really relaunched it as we listed about 6 months ago. I guess we're dual funded, and that is something that, as the chairman of the business, I love, having managed the largest mortgage business in the country through the GFC and saw what happened to competitors as people pulled funding lines. I think the importance of diversified funding is vital. So as we listed, we use our listed equity capital as an initial funding source. We then sell those loans, so they get recycled anywhere between, the theory is anywhere between every 2 weeks to about every month. When I say in theory, we've actually just, in the last 2 weeks, finalised our first sale to a wholesale institutional investor that was to Macquarie, which is fantastic for us, because as someone that was a vital partner to me during the Aussie days, they are, I think, the leading group in terms of sort of starting to get new securitisations going, and this will be that one. And then the third leg of the stool, I guess, is our retail fund that we are in the middle of rewriting the PDS for, and that should be back up in the next couple of weeks. And that's really just for mum and dad retail investors that don't want to be selecting loans of their own. They can just lend into the fund, and the fund will invest in a diverse portfolio of loans.
Great, thanks, Stephen. And Stuart Stoyan, welcome. You're a tech entrepreneur because you're wearing the T-shirt, I know that. Tell us a little bit about Moneyplace.
The T-shirt's just so I know where I work. That's the main thing there. First off, just congrats to Glenn and the AltFi team. This is a tremendous turnout. I'm pretty gobsmacked and amazed at the interest in our fledgling little industry. So, Glenn, you're floating around. Well done. Moneyplace is a consumer-based peer-to-peer lender. We are based in Melbourne. We have both a retail and a wholesale license, so we have the ability to have retail customers and wholesale customers. At the moment, we've been launched for a couple of months, and we focus very much on our institutional and wholesale investors. So we have some high net worth investors, and we also have a large investment, a $60 million investment that came through from from AusWide. So Martin Barrett, the CEO of AusWide, is here today. He'll be speaking a little bit later on in terms of the investor panel. For us, it's really about just opening up new markets and opening up opportunities. And we see that a really strong focus around risk and risk credentials, and we'll touch on this a little bit later, but a lot of the focus on us is very much about really getting into the understanding of consumer credit and what that means.
Thanks, Stuart. Well, let's start by talking about the problem that we're trying to fix here. Ben, why should customers care about peer-to-peer lending or marketplace lending over other more traditional sources of finance?
Yeah, I think fundamentally it comes down to a couple of things from a pure functional perspective, and that's convenience and rate on the Harmoney platform. So we do a lot of research with our customers who onboard with us, and obviously all the customers have relationships with banks and long established relationships. So we often go to great lengths to understand why they would choose Harmoney over any of the other offers out there in the marketplace. And it does come down to convenience and rate. And so if I can touch on convenience. Convenience is, on the Harmoney platform, it's a 10-minute, fully online, very easy to use application process where we do everything in an automated sense, from ID checking, income checking, credit assessment, contracts, everything else is online. So within about 10 minutes, you can, get well through the application. We find that a lot of our customers are 45 years old, mortgage, married, couple of kids in the suburbs, wanting to consolidate debt is a big one, and or to renovate the kitchen and so forth, so home improvement. And they're doing it after 8:30 at night. So they both work or they're both busy during the day. They don't want to go to the bank. They don't want to go in and present some pay slips and go back a second time, sign some contracts, etc. They're doing it when the kids are in bed, right? So convenience is a big factor there, and rate as well. So we obviously rate for risk, and so based on the credit experience and your profile and your applicant details, we will give you a rate that varies. It's not a fixed rate, so we would be cheaper than the banks from the unsecured personal lending loan rate for much of our book. So convenience and rate are probably the biggest things that drive customers initially, but I think there's a lot of deeper emotional and social things that surround our brand as well, which I can touch on later.
Okay. Thanks, Ben. Stuart, I'm sorry, Stephen. What are the three things that customers want in this digital age?
I actually think rate, ironically, is not digital, but rate is fundamentally true. And you are seeing, even if again, I don't want to hark back to Aussie, but every Australian is now about 600 basis points better in their mortgage because of what Aussie did to the mortgage market. As a result of that, the banks have now been ripping Australians off for a long time in the unsecured lending space. And depending on whose research, we were talking about it before, but depending on whose research, it's about 4% of assets and about 17% of earnings. So everyone in this room has been paying too much for it. So customers are aware of the better rates, so they're coming through for that. They want security and they want convenience. Security comes more in the lending space, in that if someone is just borrowing money from a platform, they don't really care about the security that much because they got the money. If they're lending money into a platform, they care about security. So that's where all the regulation, etc., comes in, and that's important. And then the technology side is, we're obviously all having to make it more convenient. We're having to make it faster. We're doing that through our distribution channels. But I don't think any of us should kid ourselves. And having just come back this morning from this World Mobile Congress, there is huge amounts of development going on within the banking world of utilising technology to bring costs down. Because the fundamental costs of running a bank for the last 50 years haven't come down. People focus on cost to income, but the actual cost of running a bank hasn't come down. And all the bankers in the room, I'm sure when you sit in a meeting, at least half the people shouldn't be there. But, and hopefully it's not the people that are in this room, but there is technology starting to come in that will bring that cost down. So when that starts happening and they're competing on price as well, then it becomes an interesting angle.
Thanks, Stephen. Stuart, ANZ's Shane Elliott was recently quoted in the press as saying that digital transformation is about improving the customer experience. Similarly, NAB's Ken Henry is saying that digital disruption is a form of innovation that NAB should embrace because it is good for customers. You used to work at NAB. So what do you think customers want, and is there a risk that the banks will catch up and overtake you in improving the customer experience?
I think that there's a risk that the banks will make efforts in this space, and some of those are going to be successful, and there's not you thrown out a couple of quotes there. Jamie Dimon, somebody I like to quote, his quote is, "Banks create friction, startups eliminate it." And so if you take that lens, what you've got is a number of people working in the industry are ex-Big Four, ex-financial services. So we're aware of where the breakages are. We're aware of where the system is broken. And that's in the half a dozen systems that daisy chain together that's a consumer lending platform. That's in the fact that you've got disjoint between tech, between branch, between everything else. So is it a focus for the banks? Absolutely it's a focus for the banks because it needs to be, for all the reasons that we've talked about here. The reality is, though, is for a bank to be able to invest in the space and to try and compete, it's going to take 3 times as long, cost 10 times as much, and then it's still not going to be good or as good. And that becomes the challenge for banks. And so that's where you do see in Wilesy's presentation earlier on, where the opportunity really is, well, do we partner, do we acquire, or whatever else? And I think that gets to the ability for banks, large and small, to be able to look to the space. We see the ability to actually partner with banks as being really critical here. And so the interest from banks is around understanding the approach that's being taken, understanding the additional data, the non-traditional data that's going into some of the credit algorithms to be able to better decision, to be able to use risk-based pricing, to be able to provide customers with a better, fairer price, as well as the overall sort of user experience that's then wrapped around in, which whenever you get the opportunity to address people from banks or banking community, usually there's sort of eyes glazed over, jaws on the floor, because everything that we talk about that we're doing today that we can do in minutes or seconds, banks have had that waiting for 12 months. It took the Big Four banks, largely 7 or 8 years to get comprehensive credit reporting up and running in Australia. Well, if that's the pace that the Big Four are running at, I'm feeling reasonably safe.
Can I just quickly add something to Stuart, because I think Stuart's point is absolutely valid. The banks do eventually, they try and do this and then they go and buy things. But my plea to any banks in this room are partner, don't buy. Because let's just look at the history of banks buying businesses in Australia. Remember those great companies called Potter Warburg, JB Weir, MLC. Banks kill businesses that they buy. They add that complexity, they add that weight of management. Startups need to be nimble, new businesses need to be nimble, partner and get the performance that way. Aussie was fantastic because banks managed to get customers. That was how they acquired customers. Once you actually acquire businesses completely, it just becomes stultifying.
I don't know about you, Stephen, but I'm missing monthly steering committee meetings with a 3-week sort of pre-wire process ahead of it.
So sad, isn't it?
Stephen, is there going to be too many nimble new startups trying to create consumer brands in this space over the next few years?
Nowhere near. Nowhere near. I think what you are going to see is that you will, in each of the spaces you will see a lot start, and there may be consolidation, but I think the reality is some will fail, and I don't think they'll fail spectacularly. They'll just disappear because of lack of size, and those customers will go in somewhere else. And in the end, you'll get some very large alternative finance businesses that are not just specialists in SME and consumers, but you'll get some alternative financial banks that aren't taking on risk. They're not necessarily APRA regulated because they're passing risk through, and that shouldn't be seen as a terrible thing to say, because if a bank takes on the risk, they need to be regulated. But if you're passing it through, there are other models that work, and you're seeing that around the world. So no, this is a huge market, and we are just seeing the start of it.
I'd agree with that completely. We're in that first cycle, or first stage of that cycle. I think there's a lot more entrants this year and next year potentially. I attend a lot of the meetups at the hubs, the technology hubs, and there's a lot of interest. In the 100 or 200 people that turn up to those events, there's a lot of people thinking about doing it or halfway through putting their plan together or their business together. And so I think there's a lot more of that wave to come through, and we're still in that first stage.
It's an easy call to say marketplace lending's gone. There's half a dozen competitors. James, needs to write articles, and his question before, there are 6 to 8 small business lenders. So make it too competitive. There's 180, 190 banks, credit unions, mutuals in Australia. There's 4 major banks, the big 4. I don't hear anybody saying banking's crowded. It's not an industry. So I think the opportunity is absolutely there for a number of players to be able to sort of carve out not just necessarily a niche for them in terms of their own proposition, but also to really be able to deliver value to the Australian consumer base, in particular for this panel, which has largely been ignored. Stephen sort of pointed at some stats there around the profitability of consumer lending. The fact that you've had a credit card and a personal loan margin that's the spread that's doubled in the last 25 years is ridiculous. The fact that it's the most profitable, you've got segments that are generating ROEs of 100% plus. That just shouldn't be happening. So I think that creates opportunity for a number of players to be able to capitalise on the opportunity, but also to be able to partner with banks, to be able to partner with other financial services and non-financial services institutions to bring a better proposition to one and every Australian.
Yeah, and it's the size of the market too. It's huge. It's about 100 billion in how we calculate it and what we're targeting. And that's a combination of both the credit card market and the unsecured personal lending of the big banks. So 100 billion is a huge market to go after. It's 5 times the size of the New Zealand market where we operate successfully at the moment. So we're very confident that this is just still in its early stages.
Well, let's get to the nuts and bolts of how you get a slice of that $100 billion market. You start from the prospect that building any marketplace is difficult. You've got to build buyers and sellers. You've got to build them and grow them at the consistent same time. You've got to hope they show up at the same time. If you acknowledge, following on Noah's discussion this morning, if you look at sort of low acceptance, scepticism, stampede, we're definitely at low awareness. Stuart, starting with you, how are you going to build a great consumer brand at Moneyplace?
So the key issue there for Australia is awareness. As much as I don't like to admit it, as much as everybody in this room probably doesn't like to admit it, banking is inherently boring. We like to sit there and we like to think about 3-year, 5-year, 7-year fixed rate, variable rate, it's got a ratchet to this or it's tied to that or whatever. Unfortunately, consumers don't just wake up in the morning and go, I'd love to get a 5-year unsecured loan with a fixed rate with no penalty for early repayments. They wake up in the morning and go, I'd like a car, I'd like a holiday, or you know what, I'd like to sort out this crap that is my financial well-being because for the last 3 years I've been a little bit asleep. And I'm up to my ears in debt and I don't understand. I don't have financial literacy. I'm not financially numerate. And so the challenge for us is not just about raising awareness, because we can do that and we can preach and we can shout, but it's actually how do you address that inertia? How do you make this a topic that somebody actually is interested in? Is it as simple as conveying what that interest saving is or what that time saving is? You'll have your debt repaid sooner. You'll be saving X $1,000s of interest. It astounds me that you can have people that just don't understand how credit cards work or how a loan works, or even now in a positive reporting environment, how positive reporting works. Oh, that's okay. I didn't pay my bill. That's fine. It's not going to cause me any grief. No, and that's actually a real shame for Australia. Whereas compared to markets like the United States, where you've got websites that are built around matching a date with a FICO score. Is this person creditworthy? Yes. Are they going to stiff me for a drink? No. So that's the challenge for us in Australia first and foremost. And I think that's a 5 to 10 year run.
Stephen?
Yeah, I mean, I guess going back to how do we get awareness? I mean, we're doing the sort of dual thing. We obviously the whole online thing, and having been on the technology panel for one of the biggest banks in the world 15 years ago, I've been sort of playing in the internet space for that long, and I fundamentally believe that it is not a good way of acquiring customers. We used to, at Aussie, for example, we saw 1 in 3 Australian customers that applied for a mortgage. 1 in 3. That was online. But our market share was only about 5% in the end. So you actually don't convert that high. So we've actually, we're doing that, but at the same time we have got a very focused strategy into the mortgage broker space and real estate space. And when 60% of Australians use a mortgage broker and about 80% of people that have taken out a mortgage look for a home, look for a personal loan, You know, that's for us firmly the focus. And that equally addresses what Stuart was saying, that people don't know. And even if it's a personal loan, let alone a mortgage, they need someone to talk about it. And even if it's just to say, yes, take 3 years, not 5 years, or yes, take it with these guys. So that distribution channel for us is absolutely vital. And you know, yes, it's more expensive than doing it all online, but when you look at the conversion rates, you know, it's much higher.
Ben?
Yeah, I think what Stuart said was fundamental. It's awareness. So we've built a great brand in New Zealand, and we have significant awareness over there now after 18 months of a lot of hard work. You know, we're fortunate in that our senior management team has pretty much a combined or cumulative experience of about 150 years in personal or consumer lending, both in Australia and New Zealand, across all the sort of normal facets of a corporate lender. So we're quite fortunate from a operations, marketing, and advertising perspective, and we do both offline and online, because we're right. We're not just an online lender by any stretch. We're building a business. We're building a brand, and we do a lot of offline and broadcast media to build that brand awareness, plus a lot of online. So now we're right up there from a Google search perspective in the New Zealand market. If you just do a generic loan search in Google, we're one of the highest ranked. But that took a lot of work, a lot of effort, and it's such a huge effort. It's mind-boggling. But we're certainly on that trajectory in Australia as well. There's a lot of parallels between Australia and New Zealand. And I guess fundamentally part of it, just echoing the other panellists, people don't talk about finance. Maybe mortgages a little bit, but you know, around the Sunday barbecue, you don't talk about your car loan, or you don't talk about your personal loan for your holiday, and so forth. But what we found is that consumers or mum and dads do talk about their investments, and the retail mum and dad, the retail investor side of the marketplace is quite important for us in building awareness, building credibility, and engaging consumers, because you know, many people talk about investments, and they talk that through to at a Sunday barbecue to many other people who might be then lenders.
Some of that's got to come back though to the industry taking upon itself, and this is broader than just the consumer lending industry, but the disruptive industry, disruptive finance or alternative finance industry, has to become more aware to the Australian community generally, because none of us can compete. You know, even little old Aussie used to spend about $25 million a year in advertising. Now, you compare that to any of the banks, let alone any of the mutuals and things, it's just obscene how much they spend. So none of us are going to compete in that space. We just have to get Australians aware that there is a real alternative that is just about better, always better for them. Once they start supporting it, then it's a different world. But we can't really just spend the wholesale advertising money that others do.
Thank you, Kieren. And in fact, I was just going to ask a question. You've just raised exactly that issue. You could probably spot by the flowery shirt, I come out of a media background originally, and I tend to hang out with a lot of advertising execs. Very depressing. There's a good rule amongst advertising guys, is £100 million is a brand cost. If you don't spend £100 million, doesn't work. And there's a damn good reason why HSBC's images is plastered over every single airport on planet Earth.
It's a great deal.
Yeah, exactly. You've got a lot of institutional money going to come into the consumer lending space over the next 3 or 4 years if the American example is anything to go by. It's going to be an institutional player. They're going to want origination. Same question I asked before, isn't it? It's origination. How are you going to do this without spending 20, 30, 40, $50 million? I don't understand how you're going to do it. How are you going to... Because it's all good and well you saying we're going to increase awareness and all that kind of stuff. Yeah, I get that. But if the customer doesn't know who you are, you're not going to get origination.
I think we would all have daily debates, I'm certain, and I haven't spoken to the guys about it, but we would have daily debates about, is the challenge origination or funding? And at the moment, we could originate as much as we wanted. The challenge has been funding. Once you get the funding sorted, then the origination will come through, but they're the two balances we have to have.
But when the institutional funders come in, and they're going to start giving you 30, 40, 50, 60, 70, 100 million, 200 million bucket, you're not going to be able to originate
so
though.
We're already there, and with the strong institutional backing out, we've now flipped over to the other side, right? Which says our challenge is origination. And that's the constant battle that we're going to have as the industry evolves. In terms of origination, I think your point's sort of fair. Yes, you need to build awareness, you need to advertise. What you've heard from the panel today, though, is through digital acquisition, through potentially some sort of offline DM, but in particular through partnering, through using brokers, through partnering with other non-traditional financial service providers, but also partnering with traditional financial service providers, helping support some of the smaller institutions that maybe don't have the same singular focus that a peer-to-peer lender has on developing a great consumer lending proposition. That actually is a great opportunity for our platforms to be able to partner with incumbents and to then be able to gain customers through referral programs or whatever it may be.
Can I just add to that? The banks need to think of us as partners. The same way mortgage brokers took customers to banks, we take customers to banks. We do consumer lending. But then the banks go and can resell the mortgages, the credit cards, the insurance, the whatever they want. We are a wonderful customer acquisition tool for banks.
Just very last question then. Surely the little bankers sitting here, they're thinking, well, I don't necessarily want to set up a platform and I work at a big bank. Why don't I just set up a challenger bank who does exactly what you do, and just does it better, bigger? And the reason I don't ask that kind of out of nowhere is because that is exactly what's happening in the UK. Your single biggest competitors are challenger banks.
But you look at the success of challenger banks in this market and they've actually been largely unsuccessful. Some of them have thrived and then been smothered as they've been pulled back into the fold. ANZ had OnDeck, which they sort of tried for a number of years to actually run that. I think Ubank is probably the best example of that happening sort of here in Australia at the moment. But a lot of that also comes back to this misconstrued view of trust. And banks like to hang their hat on the fact that, but the customer trusts us. Why? We're a 200-year-old institution. Well, not necessarily. I mean, look at the GFC, look at the financial planning scandals, look at the fee sort of Senate inquiry around credit card fees and PL fees. I think that trust is a little bit of a misnomer. And that's why consumers are as much as I probably don't want to go here, as the American population is looking to Donald Trump for an alternative. You'll see that Australian consumers are also looking for that alternative because there is a burning platform which is, hey, we're sick and tired of being ripped off.
On the devastating second mention of Donald Trump in one day, and the alignment of this industry with Donald Trump, well, I mean, he's going to win the American election, so you'll probably be right. Anyway, listen, Kieren, you've done a great job. Thank you very much. Put your hands together for our panel.